You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music can mean only one thing. It is Thursday. It is 1:30 p.m. Central, 2:30 p.m. Eastern. Do you know what's going on in the world of futures options? Well, let's find out together. Yes, it is time for TWIFO. This Week in Futures Options. My name is Mark Longo from theoptionsinsider.com, as well as from this network upon which so many of you have been binging, not just TWIFO, but the option block and volatility views and the advisor's option and everything else we crank out here, OPR, options boot camp, and so on and so forth. You guys are loving it. Remember, if you like what you hear, keep those reviews coming on your platform of choice. Could be anywhere. Could be Apple Podcasts. Could be Spotify. Could be Amazon Music. We just added them recently as well. So if you want to like us there, wherever you get this show, make sure you keep liking it, sharing it, reviewing it so other folks can continue to discover this network. We've seen just a huge influx of people just over the course of the past year. And we want to keep those people happy, engaged, entertained. Want new people discover the network continuously here because it's more important than ever in these troubled times. So if you like what you hear, leave those reviews. Keep new folks discovering the network. We've been chugging on for a long time, coming up on 14 years here in January, which is crazy when you say it out loud. But there's still new people out there who are discovering these markets. Look at the explosion of Robinhood volume, for example. And they need a place to turn to. So we're happy to serve that and give them a reliable source of information. So keep those reviews coming. We do love to hear from you. Also love hearing your questions, so keep those coming for TWIFO and all the other programs we have going out there today. Let's see who we're hearing from on the old TWIFO program today. First, holding down the FTSE Russell hot seat once again, my old friend, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. Mr. Smith, welcome back to TWIFO, sir. It has been too long.
Hey, Mark. Thanks for having me on the show. Great to be here. Looking forward to some fantastic discussion today. We got lots of things to talk about. Equities are obviously a great subject, but looking forward to diversifying that call and having some really good conversation today. So thanks for having me.
Joining us to have that good conversation today, holding down the CME Group hot seat, is Jeff WHITT, the co-founder at Simply Derivative. Jeff, welcome back to TWIFO, sir.
Yeah, hi, Mark. Hey, Sean. Hope you guys are doing well. Thanks for having me back. I know it's been a while since I was last here.
Yeah, Jeff, by my count, you were last on right before everything went to hell in a handbasket. You were on pretty much the week before that, back on March 12th here on TWIFO. So obviously quite a bit has unfolded in the world and indeed the marketplace since that March date. And also, we've also had a huge influx of new listeners discover the program since that time. So maybe let's start there. Give our new listeners a little bit of a quick overview what the heck Simply Derivative is, what you guys do, and then B, catch us up. How have you guys been doing? How have you been faring over the course of these mad pandemic months, sir?
Yeah, absolutely. As everybody knows, it's been a crazy year. A lot has gone on, not just in the world, but also in the markets. And, it's a great time for new traders to come in and take a listen and learn what the markets are all about. We've seen plenty of opportunities all over the place. So we've been definitely staying busy, and it's been a good time in the markets, even though, the world has been seeing some things that we've never seen before. So, but on our end, what we do at Simply Derivative, we basically teach newer traders how to understand the markets, how to distill market movement using price action and technical analysis, and then apply that as our primary decision-making tool in the markets, whether it's futures options, or equities or equity options. And that's really what we do. And, we're happy to be here.
And what we do here on the show is break down the futures and options market. So let's kick it off a little bit of the old movers and shakers.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, let's do it. Time for the movers and shakers. We profile the big swingers to the upside and to the downside, a.k.a. the light side and the dark side at CME Group. Since our last show, so this goes back to the end of TWIFO last week, and it's another pretty evenly split week, actually. Usually these days it's dominated by one direction or the other. It's pretty much all red or it's all green. This week it's almost exactly evenly split between upside and dark side, even though percentage-wise the upside has some big movers out there. Jeff, you're our guest today, holding down the CME hot seat. I will give you the pride of place to choose. Where should we begin our journey this week, sir? To the light side or to the dark side?
Let's start with the light side. Let's go with that.
I think Sean's going to like you. You two are of a similar mind. All right, we're going upside first, listeners. Number 5 to the upside this week is corn. Our old friend corn, up about 2.5%, almost 2.6% out there for number 5. Number 4, lean hogs. Also moving to the upside, up about 3.6%. It was number 2 to the light side last week, up nearly 7%. So a good couple of weeks out there in the hog territory. Hashtag hog love for all of you out there who trade those with gusto. Number 3, you guys are always asking us, how does crypto fit in? Well, it's in the top 5 this week. Bitcoin up nearly about 4.5%, 4.56% out there. It was a pale shadow of that last week. Number 22 on the upside last week, up about not even 1.5% last week. Then we're going back to dairy. I think we had a question about dairy last week. Dairy lighting it up again this week, up just a tick under 7%, 6.99% for our old friend Class 3 milk. It was number 4 to the dark side last week, off about 2.75%. And number 1 with the bullet, yeah, you can probably guess it. It's nat gas, up a whopping almost 30%. Since our last show, 29.58%. It was number 15 to the upside last week, up a paltry 2.77%. Now, before you get all excited about that, we know nat gas, a little bit of a cheaper product, a little bit shy of $3 out there these days. So not exactly a $600 product moving 30%. So bear that in mind, but still interesting stuff out there in nat gas. And then to the dark side, let's go before we get to number 5, let's go a little bit outside the top 5, all the way down to number 11. That's where we find our friends, the Russell 2000, off not quite 2%, about 1.7%. It was number 6 to the upside last week, up about a little over 6%, about 6.2%. So that would have been good enough for pretty much number 3 this week, but it's a little bit stronger upside week, it seems like, percentage-wise this week. And number 5 to the dark side, palladium, off 2.7%. Number 4, Brent, off about 2.95%. Numero trace here, WTI giving up more of that upside, off about 3.6%. It was number 5 to the upside last week, up about 6.5%. Then we've got lumber, off about 6.33%. Number 1 to the dark side last week, off a little over 7%, so a rough couple of weeks for lumber. And number 1 with the bullet, RBOB this week, listeners, off about 7.8%. It was number 3 to the upside last week as well. So a lot to unpack there. Jeff, I hear you're a fan of all things energy out there. So what do you say we start in the energy complex, sir?
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
Yeah, let's do it. It's been pretty fantastic as of late, and like you mentioned on the light side with natural gas having a big week last week. If you take a look back, really since June, I believe it was end of June through a couple days ago. I mean, how could you not enjoy? It looked like over 100% rally in natural gas, and we've been trading it from the long side all year, but specifically the last 3 or 4 months have really been great for us, and definitely utilizing those options on the futures has allowed us to stay in the game a little bit longer than we normally would if we were just trading the futures by themselves. So,
all right, well said. You guys, as always, can find this cmegroup.com/TWIFO. That goes for all the products we're going to break down here today. /TWIO, TWIO also works. If you do that, go on into the energy drop down. Let's stop first at nat gas. It's been moving, obviously, and Jeff was just chatting about it here. It was, of course, number 1 with the bullet, up 29.5%. I should point out that's from last week's show. If you actually pull up the TWIFO report for this weekend, that comes from the beginning of this week. So it's a little bit different frame of reference. It's only up about 1.5% since the beginning of the week. So a lot of that swing obviously coming after our show last week and before the end of the week. Coming into showtime, we're seeing that front nat gas future at about 279 or so out there. So interesting stuff, a little bit shy of that $3 level. You go a little bit beyond that, though. You go out to decent. It's up over 3, about 3.25. So it has been impressive percentage swings out there in nat gas. Looks like almost half of the paper, 49% of the paper, also going up out there in that November contract. It has about 12 days to go. So we'll keep our eye of Sauron fixed out there, even though it is technically inside of our 2-week barometer that we like to use for measuring things like vol and skew. Speaking of that vol, it is about a 71 and change in that front contract. That puts it down 8, almost 9 handles. So the vol actually coming in, despite the fact that we're seeing a pretty big swing out here in all things nat gas. And in terms of skew, let's dig into it a little bit. Let's see. The puts last week, almost 2.5% rich. They at the money, about 2.4%. This week, still rich, but not quite as rich, about 2% rich. They at the money. The calls last week, 1.5% cheap. This week, 1.3% cheap. So despite the fact that we had a pretty sizable swing since our last show, not a huge change from a skew perspective, which is a little surprising. In terms of how much paper does nat gas do out here these days, about 440,000 contracts on the tape this week. So it's a pretty active product, which is interesting too because the underlying future, not that expensive. So a lot of times you can argue the cheap products by themselves are kind of like an option, and yet the option's doing quite a bit of paper here on a $3 name. If you had a $3 equity, for example, I don't think you'd see as much options paper going up around it. So interesting stuff out here. The number 1 trade out here, number 1 contract out here this week were the 3/4 calls that are going out in November. So just in about 12 days. Pretty active throughout the week. Almost 11,000 going up on Monday, about 10,200 on Wednesday. The rest scattered throughout the week. Total about 30. Almost 31,000 going up here this week. A lot of back and forth, opening and closing as we're threatening the strike, then retreating from it back and forth. So a lot of paper on that 3/4 strike, followed by, looks like, the 3/2 calls. So a little bit farther out of the money, doing almost 20,000 contracts. The lion's share on Monday as well, about 10,000. So about half of that paper going up on Monday. A good chunk of that was opening. Then we go to the 2/2 puts, doing about 15,000 contracts. Those were the lion's share also on Monday, with about 5,300 going up, the lion's share of those closing out there. Interesting stuff. We don't get a chance to talk nat gas too often, like we said, because it's percentage swings on a pretty cheap underlying. But that said, it's doing some paper. It's obviously capturing the imagination. Jeff, it sounds out there like you guys have been trading it as well. Have a lot of your clients been coming in looking for trade nat gas? And if so, what have they been up to?
Oh, yeah, definitely. We've been looking at this product for quite some time, and it had been range bound for a while to start out the year. And then we finally made a break toward the lows below $1.50 in that end of June time frame. And so once we were able to reclaim 170, 180, we were looking for a stronger push back up to the 250 area. And, a lot of our clients, a lot of our traders that we work with are in the future side of it. But the ones that are a little more experienced are definitely utilizing the options. We're doing anything from the at the money to about 10 or 15% out of the money, just getting long calls going out about 60 to 90 days. So it's worked out for us, as you can see. It's actually been moving. You don't hear that, like you said, a lot with the nat gas and a lot of people trading it just because the movement may or may not be there, and it had been range bound for quite some time. And then we see some really explosive moves in the last couple months. And when there's volatility, that's where us traders like to be at.
Yeah, definitely. It's surprising we haven't seen more skew changes given the explosive moves you've seen out there of late. But it seems like the market not pricing in enormous moves in either direction to come. But we'll keep an eye on that and keep rolling. Since we're in the energy complex as well, we got to stop in our old friend WTI as well. You guys can just switch that drop down in the energy to go to WTI listeners to follow along. If you do that, you'll see that coming into showtime, we're seeing WTI at a little bit north of the 41 handle, 41 and change. That puts it up about 2/3% on the week here. So again, that's from the beginning of this week, not from last show. Obviously off a little bit from last show. In terms of what we're seeing out here, it was the Dees contract with about 33 days to go that did the lion's share of the paper out here this week, about 58, almost 59% going up out there. Let's look what's going on out there in Dees. Vol up a bit in Dees. It's pretty juicy right now, actually, at about a 42.5. That's up about 2 3/4 points. That puts it on par with some of these more volatile equities we're seeing out there. Even some of these large caps that we've seen of late, like, your Apples and Amazons and others have started to merit extremely high levels of volatility. And a 42 is getting up there. It's not quite at the 60s, which we saw Apple at very recently, and again, Bitcoin is hovering around these levels. So getting similar levels of vol for WTI and for things like Bitcoin and for large cap equities as well. It is kind of interesting out there. Remember we talked a while ago about the cross-correlation we saw across different asset classes. Interesting correlation between equities and all things WTI. In terms of what was lighting it up this week out here, Dees did about 58, almost 59% of the paper, and it was the Dees 50 calls lighting it up with about 14,000 contracts to number one. By the way, a little bit lighter week out here for WTI, only about a little bit north of 250,000 contracts on the tape. So nat gas kind of eclipsing WTI this week, at least from an overall volume perspective. And what's active out here? Well, I said the 50 calls in Dees were where the biggest prints were this week, about 14, almost a little bit north of 14,000. The lion's share was on Wednesday, 10,800 going up there. The rest kind of scattered throughout the week. A good chunk of that closing as well. So it seems like someone perhaps giving up the ghost on these Dees 50s, saying, maybe not getting there anytime soon. Hard to argue with them. We've had guests on multiple shows. We've had Scott Nations on our Option Block show a couple of weeks ago and others, and pretty much all of them have been arguing against WTI really having any sort of demand scenario that maintains it north of 40 for any sustainable period of time. And it sounds like these people on the 50 call strike may be agreeing with that, taking some of that off the docket here. Also, 45 calls. Actually, I take that back. 46 calls. Also pretty active with about 12,000. The lion's share also on Wednesday, about 8,400. And the lion's share of those also closing. So maybe a bit of a vertical coming off, a 46.50 vertical. That might make a little bit more sense why those 2 pages and those 2 days are lined up so closely. But either way, looks like someone giving up the ghost on the 50 strike and indeed the 40 strike out there. Today, a little bit lighter, about 2,500, but still pretty active on those. Also on the put side, you got the 31 puts lighting it up to the tune of about 11,300. The big days were actually kind of tied. 4,200 each on Tuesday and on Wednesday. Both of those days actually opening. So closing to the upside, opening to the downside. Put side, not exactly surprising. That's kind of been a theme we've seen of late out here in all things WTI. Let's look at the skew and see if the skew is backing that up. Last week, the puts were 16.1% rich to the at the money. This week, almost 20%, 19.8. So this puts getting a hefty bid. Remember, we said that at the money vol in Dees is about a 42.5. You're paying nearly a 20% premium to get the 25 delta put out there. So that's getting pretty rich out there. Obviously, some folks still fading this north of 40 pretty aggressively. To the upside, the calls were 10.4% cheap. This week, 12.1% cheap. So getting cheaper. So interesting. Again, this skew shape we've been seeing for a while here that fades anything north of 40 is continuing and indeed getting more aggressive out there. Jeff, you say you guys trade a lot of energy. A, do you guys play in crude oil? And then if so, what have you been seeing out there? And what do you make of these continued rallies and then falterings north of 40 in WTI, sir?
Yeah, we definitely trade crude oil. It's one of our products that we focus on quite a bit. And like you said, yeah, anytime crude in the past month and a half gets over 40, 41, it sells off. And so what is that telling us? We're holding the 37 level. We're basically range bound. We put in some highs, recent highs, around 43.75, and we have not been able to get above that. So we've been really just trading the ranges. When it gets above 40, 41, we sell it. When it gets below 38, 37, we buy it. We're waiting for a break above that 45 strike that you talked about, and we'd be looking to sell some calls if that happened. As you said, it's hard to see a scenario where the demand for crude is really going to drive prices up. At least in the near term. I know seasonally we may see some weakness going into the end of the year, and then about mid-December through March, February is when you see crude oil's strongest period in time during the year. So we'd wait kind of until we see this thing shake out a little bit, and then we'd be looking to maybe get long with an anticipation of reclaiming that 45 and maybe getting back up to the 50s. So that's what we've been doing and kind of what we're looking at.
Well, crude bulls might be pointing out, hey, but it's over 40 right now and it's held up a little bit. Well, this is obviously a hurricane week, listeners, so things are a little bit different out there. We saw stockpiles falling for crude and pretty much distillates across the board last week as pretty much just about everything in the Gulf was shut down due to Hurricane Delta. Again, how scary is it? We're already in the Greek alphabet for hurricanes. Yet another gift of the year. That is 2020. So we saw a distillate inventory, so all the refined products posting their biggest drop since 2003 as refiners shutting down out there. So all of that contributing to this near-term lift. Doesn't seem like the market is really given this near-term lift much legs, though, listeners. And once these hurricanes hopefully calm down in that region, might see a little bit of this fade. And again, the options paper lining up that way. And sounds like, Jeff, you guys and your clients over there lining up that way as well. But now it's time for us to keep on rolling out of energy into another E-named product. Let's kick off a little bit of equities.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, let's do it. Let's break down the vol, the skew, all the good stuff going on in the world of your favorite equity indices. Interesting stuff popping off to set the stage here. Coming into showtime, we saw a lot of movement out there on the equity vol front since our last show. Let's start with our old friend RVX, a.k.a. the VIX of the Russell 2000. It was holding pretty much unched until right before showtime. Of course, looking at the broad indices today, listeners, we did see a pretty pronounced sell-off to kick off the session. Most of the major indices, NASDAQ was off well over 1%. The S&P was off over 0.5%, closing in on 0.2%. It seems like that sell-off is mitigating now. S&P off about a third, actually about almost 0.4%. The NASDAQ off less than 1% now. The Dow a little bit shy of unch to the dark side there. So if that sell-off continues to mitigate, then we might see vol coming in, because that's exactly what we saw in RVX. It was trading almost 1.5 points higher, but then coming into showtime, it gave up a lot of that ghost down to about a 32.35. So still elevated, but off a wee bit from where it was this time last week. And VIX coming into showtime was at about 27.35, so pretty much about exactly 5 handles away, and up about 0.25 point, like we mentioned. That VIX RVX spread now at about exactly 5 handles. That puts it about 1.5 points tighter than what it was this time last week. Again, that's an interesting line of demarcation to watch what's going on. Large cap vol versus small cap vol, because we know in this economy right now, in this pandemic world, different things happening in those different indices. Our old friends VolQ now, the futures did launch. So those are up and live. You can trade NASDAQ Vol over there at CME if you want as well. VolQ ticking up as well, up about 3.25 points from last show, puts it about 33.5. And our old friend VVIX, which is the Vol of S&P Vol of VIX, at about 120, 119.5, puts it up 15 points from where it was last time. So that's a big swing out there as vol is getting more volatile again. I know that's a little bit of an obtuse concept to wrap your head around, but that's what's going on out there. Sean, I know you've been watching all things going on in your neck of the woods. What's lighting up your tape and what's catching your eye in the world of small caps these days, sir?
Thanks, Mark. And Jeff, just a real pleasure to have you on the show. Just really enlightening information. So thank you for sharing your input there on the various market segments that you guys discussed. And energies, as you talk about the other E market sector or segment or asset class, I should say, is one that's always important. And you're right, Mark. We talk about correlations between crude and equities quite a bit. So very interesting conversation. Small caps, the talk of the town, the index that outperforms to the upside, and as we've been seeing as of late, and as you know, I always say it outperforms in both directions. It's been a really interesting trade, right? We are well north of 1,600 in the index, and looks like it's headed higher. And you know, if there's more discussion, hopefully you hear of a COVID stimulus package that bodes well for our U.S. domestic stocks, which you find in our small cap index. So interesting times. We talked about RVX versus VIX. It's interesting to see those two volatility indicators being at the level pretty close as we were last week. I think you mentioned, and you know, lots going on. We've got a big webinar coming up next week, and I'll probably bring that up later in the show, but we're going to take a really good look at large cap versus small cap performance and the performance of U.S. domestic indexes over this past year. And coming into an election season, there's some really interesting things that are driving equities. We've got a pretty good show coming up next week, of which I'll give some more color on later in the show.
Well, you're not the only one, Sean, looking at small cap versus large cap performance. Barron's coming out with a piece, I believe, right before showtime, called "It's Not Tech's Market Anymore. Small Caps Are Back in the Game." And they talk about the different levels of performances between the S&P and the Russell 2000. They point out when the large cap S&P 500 hit its record high back on September 2nd with 11% year-to-date gain. Things were looking a little bit more dire in small cap land. Russell 2000 was down nearly 5% for the year. Of course, obviously a lot of that was driven by just the explosion of mega caps like Apple and a few others that were driving the S&P 500. But since that date in September, and certainly since September 23rd, so later on in that month, Russell 2000 up nearly 13%, beating the S&P 500 by about 4 percentage points out here. So they're saying at this point that small caps are approaching their year-to-date high of 1705. So a lot to unpack there. Sean, what are your thoughts here on this analysis? Apparently you guys not the only ones setting your sights on all things small caps, sir. It's been really interesting. It's been a lagger, but we always make that comment that as the economy strengthens and there's good news happening here in the United States, small caps tend to outperform, and we are seeing that as of late. So it's been an incredible year. The Russell 2000 has been behind the other benchmarks quite a bit and have, as we said, caught up, and now the performance has been really, really strong. So it's going to be an interesting next few weeks as we come into this election and post. So there's going to be some interesting trade go on. So looking forward to continuing to have more discussion about that in the coming shows. Yeah, one of the narratives people have had for a while now is this bifurcation of the markets, how it seems like these FANG names and a handful of mega caps are dominating so much more share of the S&P 500. And it's really kind of obscuring what's going on with the rest of the economy. And people have been looking to other indices like the Russell 2000 to see what's going on with names outside of the top 5. And for a long time, those were pretty damaged. But now it seems like they're starting to catch up. The high for the year in Russell 2000 was 1705.2. That was set back in January, and it's not that far away from it here now. As the time of this article is about 100 odd points below. And now it's coming into showtime. We're seeing Russell 2000 at about 1635, so that puts it down about 70 points from its all-time high for the year. So perhaps showing a sign that the part of the economy people were most worried about, the smaller names out there, the ones that are probably less able to survive a sustained pandemic period than a Apple that's sitting on 200 plus billion in cash out there, that maybe they are showing signs of being able to survive this calamity here as well. Interesting stuff. Check it out if you haven't already over there at Barron's. The article's called "It's Not Tech's Market Anymore. Small Caps Back in the Game." Speaking of small caps out here, except 1635 is where we find ourselves in the Russell 2000 coming into showtime. Puts it off about 2 handles for the week, or about 0.1% since Monday. It's not a huge mover since Monday out here. In terms of where the action is, it's like most equities, it's in the near-dated contracts. These contracts out here that have a day to go, a day to go in the October weeklies, the week 3s, are where about a third of the paper went up this week. And actually kicking a little bit of the narrative side, usually we see it's far out of the money puts are dominating the tape. It's actually 1635 calls in that front week contract, so pretty much at the money calls, as well as 17 calls out there in DEES that are doing the lion's share of the business. In fact, 1710 calls are the number one contract out here in Russell 2000 this week, which lines up pretty closely with that year high of about 1705. I don't wonder if that's a coincidence or if that was done by design. Either way, 1710 is where the action is out here this week on the call front. Interesting stuff. If you're wondering, by the way, a small cap vol in that front contract going away in a day, so kind of mostly gamma, not that much vol, but still that's about a 31. Then it drops off a little bit. Let's go out a little bit. Let's go out to DEES because that's where saner heads are prevailing. That vol is still at about a 28.5. That's up about a point this week. So still pretty juicy out there. And from a skew perspective, let's see. Puts were a little bit more bid last week than they are this week. 18.1% rich last week, 17.6% this week. And the calls a little bit more offered, 13.2% offered last week. This week, 13.8% cheap to the at the money. Jeff, I know you guys obviously spend a lot of time and attention over there in equities land as well. What products and what markets are on your radar these days in the equity world, sir?
Yeah, we definitely do trade primarily the S&P, the E-minis, the ES, the NASDAQ, and the Russell as well. Since I was last on the show, new products were introduced into the market, the E-micro options. And so we've taken a big shine to those and got a lot of people involved in learning how to trade options on futures using these micro contracts, which have been fantastic. And so that's really what we've been doing the past couple months, is really focusing on those. But like you said, we're seeing the small caps catch up to the rest of the market. They've been down and they haven't reclaimed highs from a few years ago. And so, at this point, it looks like it may be a foregone conclusion that we at least reclaim this year's high above 1700. And then we get up to that 1746 area, which was set a couple of years ago. So we'll see what happens once we get up to that point and see where the other markets are at. But you saw the NASDAQ make new highs. You saw the S&P make new highs. You saw Dow Transports make new highs. And then we've given some of it back. And that's just kind of the ebb and flow of the markets. And we've been in rally mode for, it looks like, a couple of weeks now. And so we've been just riding the long side, looking for these highs in the Russell and see if we can retest the highs in the S&P and the NASDAQ.
Interesting you would mention those micro equity options out there, because you're right, those have been blowing the doors off of late, and they're designed, sounds like, for particularly your clientele there, Jeff, which is the smaller retail trader. Give them a little bit more bite-sized, more nuanced exposure. I've joked many times on this show. I know when Tim McCourt joined Sean and I live back when we could do such things, back down at the FIA Boca show well over a year ago now, and mentioned the impending launch of, at the time, the micro futures. It didn't seem like it was that big of a deal. Fast forward a year and change, these have become the most successful product, at least from a contract volume perspective, in the history of CME. And then go figure, the options are lighting the doors off. So it sounds like, Jeff, your clients are flocking to those products as well, sir.
Yeah, absolutely. And it kind of ties into that Robinhood effect that you're talking about. You have a lot of newer traders coming into the markets that want to have and enjoy the benefits of futures and options, but not really sure that they want to commit a lot of capital to that process of learning. And so these micro options and micro futures have been fantastic to really get newer traders involved and get them to understand what the markets are all about. And you've seen the explosion in volume this year from both of these products. So for us, it's been good just because we've been able to teach newer traders and really get them exposed to some different things outside of the stock world.
I like that, bringing that perhaps a bit of that Robinhood effect, because that's, of course, been a much discussed topic in the world of equity options, how all these retail traders are flocking to apps like Robinhood and Webull and others and just slinging mostly Apple and Tesla calls willy-nilly. But you're right, these smaller bite-sized products on the micro side, probably doing a little bit of that, maybe bring in some of that Robinhood effect, quote-unquote, to the world of futures options, which is kind of interesting. All right, Jeff, your little birdie has told me that you're a fan of all things shiny, so I think perhaps without further ado, we'll keep on rolling right on into the metals.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
That one always brings a smile to my face. Very seasonally appropriate coming up for Halloween. But I think we might have to keep it in the rotation year round because it just makes me laugh. Yes, it is time to talk metals. Let's kick it off with the big dog out here, gold. Coming into showtime, we're seeing the shiny stuff at about a 1909. Off about 16 handles or so not quite a full percent, but pretty close to it. So yet again, for all the gold bugs out there who are hoping for a sustained rally north of the 2,000 level, not so much this week. In terms of where the action was, it was out there in Dees with about exactly 32%, almost 33% of the paper going up out here in the Dees contract. If you're wondering, by the way, gold doing about 250,000 contracts this week as well. So not a huge rock'em sock'em robots week for gold, but decent paper nonetheless. Let's go out to this Dees contract, see what's up from a vol perspective. That future is at about a 1910, very close to it. And the vol, similar levels, at about a 19.5 out there, off a little bit on the week here in Dees. But again, gold vol has been an interesting thing to watch, interesting barometer for what's going on out there in the broader economy as well, and hovering right around a 19.5 right now. I guess the movement we're seeing in gold is enough to merit this level. If you're looking at the skew out here, let's see, in this Dees contract, we're looking at the puts being about 0.5% rich to the at-the-money last week, so effectively not much of a bid at all. This week, going the other way, getting a little bit cheaper, 2% almost cheap. So swinging a little bit, which is kind of interesting. Again, we have come off a little bit there. Maybe as we're threatening that 1900 strike, we've blown through some other strikes that people had hedges on maybe. So taking some of those off. As a result, maybe some of those puts coming in a little bit. The calls last week were 3% rich. This week, 5.2% rich. So again, not that surprising. It's been a bit of a gentle move down the skew. So when that happens, usually see a little bit of a pivot, see puts come in a little bit, see calls get bid, and that's pretty much exactly what we're seeing, kind of a textbook skew movement here in gold this week. In terms of where the action was out here, I mentioned folks are still fixated on this 2,000 call strike, and that's pretty much where a lot of the action was in Dees, but actually we have to go farther out to get the biggest print of the week out here. We have to go all the way out to June, listeners, and it was the June 2000, not enough for somebody out there, it was the 2100. In fact, it looks like we got another one of our funky flies going up out here in June, listeners, to the tune of the 19.5, 2100, 22.5 fly going up 5,000 by 10,000 by 5,000 times. So 5,000 of the 1950 calls, 10,000 of the 2100 calls, and then 5,000 again of the 22.5 calls. Pretty much opening on all of those strikes. So an interesting fly selection out there. Not quite as outlandish as some of the other ones we've seen. Also not quite as long dated. We've seen some very long term, 3,000 plus strike crazy verticals going up out here in gold of late. This one actually seems comparatively reasonable. It's only about 40 odd handles out of the money right now. So interesting stuff here. But again, sizable flies, sizable verticals continue to be the narrative to the upside in gold. Again, going back to what I've said, gold bugs are active out here. They demand this thing to go back up north of 2,000. In this case, this guy sounds like he wants to march right up to 2,100 out here. I'll have to dig in a little bit, see if I can get the net premiums for how all this went up. But pretty sizable opening paper out here. Beyond that, though, beyond the 2,100s, actually, I take that back. Looks like more paper went up since then. 12,000. So this fly traded again today. Went up 5,000 by 5,000 by 10,000 times yesterday. Today went up 6,000 by 12,000 by 6,000. So obviously not closing because it's doing more volume this time. So unless he closed it out and someone else came in to do 1,000 or so more, but that would be strange. So it looks like a total, listeners, of about 22,500 of the Dees 2,100 calls have traded this week, followed by 11,000 each of the 19 half and 22 half calls. What do you guys think of this fly? 19 half, 2,100, 22 half. It's an interesting one. I definitely like these strikes a lot better than some of these other more outlandish ones we've seen of late. But what do you guys think about this? It's an interesting fly and certainly dominating the tape. Nothing else really close to this. We have to go all the way back to the 2,000 even calls in Dees to find another hot contract. And those did about 8,500 contracts this week. The lion's share actually on Tuesday with about 6,000 going up. So someone else still positioning for a big move past 2,000. But yeah, it was that funky fly that's taken up all the oxygen in the room this week. Let's see if there's anything even crazier. Yeah, if you want a little bit more outlandish strikes, we still got some for you, listeners. Looks like more of that three-way actually going up today, this time in Dees of 2021, so over a year out. We've got the 22 half, 2,500, 3,000 vertical going up 1,500 by 3,000 times. So interesting stuff there. 1,500 of the 22 halves, 3,000 of the 2,500s, 3,000 of the 3,000s as well. So funkier ratios afoot out there. But that's kind of the name of the game in metals. Funky upside seems to be our trade du jour out here. Jeff, what's catching your eye out here in all things metals? What do you think about these levels here? 1,900, we were obviously past that 2,000 level, obviously giving up some of that of late. And then C, what do you think about these crazy upside verticals and flies we've been seeing going up here for weeks now in gold, sir? A lot to unpack there.
No, absolutely. Just today we noticed that the December contract, like you said, has been pretty hot. We saw a bunch, several thousand of the 2,075 calls today, along with a few thousand of the 1,675 puts. And I'm not sure if that's a strangle or not, but gold has been range bound since it's put in its high back in early August. I know we've traded down to 1860 and we're trying to hold this 1900 level. But that 2000, 2075, 2100 level going into the end of the year may not be a bad idea. Seasonally, this is when gold starts to pick up in October and November. You have the election, you throw that in there. Maybe vol stays high, the markets pull back a little bit. That uncertainty is definitely going to catch the attention of people that like gold. And so we're trying to buy on pullbacks and looking to really get involved once gold gets back above that 2,000 level.
And Jeff, what's your primary vehicle out there in gold these days? Are you mostly on the options? You're on the futures side, a little bit of both? If you want to say the futures, don't worry, I won't hold it against you.
No, it's actually both. More on the intraday swing basis, we're in the future side of it, but holding longer for weeks at a time, we're typically in the options space. And so that's kind of how we play it. And so we've been doing a little bit of both, going back and forth.
Well, Jeff, I want to get the listeners on. We've got time to squeeze in one more complex. If there's any other product that's really lighting up your radar this week, sir, let's have at it. The floor is yours. I guess by your resounding silence, nothing is lighting up your tape, Jeff. Everything else is boring.
No. Well, I was going to say volatility. The VIX has definitely been something that we've been paying attention to. We've never gotten back to the levels that we've seen prior to the market basically collapsing back in February and March. So volatility has stayed up, and there's been a few times just within the past couple months where you see vol going up at the same time the markets are going up. So that's been interesting for us, and we've been paying attention to VIX and and what's going on with that. And, like I said, with the election and the uncertainty going into the end of the year, you're going to see, I think, VIX levels remain elevated, and you may get a few pops.
Well, it's funny you bring up that, equity volatility. Obviously, that's been a big talking point on a lot of our programs here on the network. One of the interesting things we've noticed, of course, is, they were pricing in a lot of volatility, not just through the election, but beyond it into December and even January and beyond. Seems like some of that has lessened now in the wake of maybe Biden getting a little bit more demonstrable lead out there. Of course, we've all seen how this early polling, how reliable it can be. Just look at 2016 or go back to Brexit even, where they thought this thing was a done deal going the other way till it didn't. So maybe a little bit of a buyer beware when it comes to trading these things a little bit too early. But it does seem like the market is pricing in more reliability of an outcome. Do you see that as well, Jeff? And if so, what are your thoughts on that?
Yeah, I do. It's definitely come in the past couple of weeks. It's definitely slowed down a little bit. But I still think, just like in 2016, when everybody was on one side of the trade, when everybody thought that Hillary was definitely going to be the one, you saw what happened in the equity market. You saw what happened on that election night. So I'm not taking anything for granted, really. And, there's no to say that, this election doesn't turn into something that's a little more than what everybody's expecting, and that's where you saw that tail end going into December, maybe end of year kind of thing. And so, I wouldn't be surprised if something shocking happened. But we're relying on our charts and the price action and just letting that dictate of really what we're looking at and what we're planning on doing, kind of thing.
Well, let's see if something surprising happens with your letters and with your tweets and everything else. It is time for your Futures Options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to your segment, the portion of the show where you guys take the reins. Let's kick it off here with Andrew. Andrew T. He wants to know, why have I heard people say futures options are illiquid and have wide spreads? The ones that I have looked at, and he puts in parentheses, corn, gold, wheat, and others, tend to have decently tight spreads. Well, Andrew, I'm not sure where you're getting your information from, but you come into the right place. You hear something weird, you hear a rumor floating around on the internet, come to us here on the network. We'll set you straight. But the truth is, futures options are like any other options product out there, right? And that the ones that have the most activity around them, the big names that you've heard of, and a lot of the ones you list here, corn, gold, wheat, equities, WTI, those are some of the big dogs out there. So they're going to be very tight. They're going to be very liquid. And that's probably what you're going to find. But if you go farther out, we've talked about it here before on the show, some of the products that don't trade as actively or trade, by appointment, things like lumber. Lean hog's getting a little bit better. It used to be that way. Some of the dairy products, some of the more esoteric products out there, those are obviously going to be wider and less liquid because there's just not as much paper going up. It's a bit of a catch-22. You need more paper to drive tighter markets, but tighter markets will drive more paper. It's kind of a weird problem that new products always have. And so it seems like it's taken time. Products like dairy seem like they're starting to get more into the mix and on the radar of people out there. And as that grows, we just kind of joked earlier about the Robin Hood effect of these micros, but I think there's something to that as well. Getting more people into these products and discovering all things futures options. They then spread that liquidity out to other products. Hey, I like these micro, E-mini Russell 2000 or S&P. Let me check out some of these other ones. What's going on in corn, maybe? Or what's going on in WTI? And it seemed like it's a good spillover effect. So yeah, I don't know where you're getting your information there from, Andrew, but glad to have you listening to the show. We'll set you straight. And one of the interesting things I will point out, too, about futures options is like, if you look at the equity space, your big dogs, your Apples and things like that, a lot of those typically have a lot of liquidity around front month at the money. And then it tends to dissipate. Even in the more active names, the farther out you go in time and the farther away you go from the at the money. We see less of that in futures options. In fact, some of these products like the ags and other ones that have, very clearly defined liquidity cycles, maybe on the harvesting front or on the production and refining side or things like OPEC, they have liquidity going out in much longer months and much tighter farther out you're going to see in some of these other products as well. So that's an interesting caveat that people discover when they come to futures options. Hey, I can actually trade more than just front month at the money, which is a nice discovery that I can go out a few months and there's actually some liquidity there, which is kind of nice to see, whereas it tends to dry up in a lot of the other major, equity options you see out there. Also, another caveat is you get a little bit more trading hours here. So if you're that guy who wants to be glued to your screen in the middle of the night, you can do that here with a lot of these futures options, whereas you still have your regular hours for most of the big equity options out there. So it's just a few differentiating points there, Andrew, but a good question. All right, next up, we've got frequent listener here, frequent question asker, Baiju Thomas. He says, hi, Mark. Well, hello, Baiju. He says he has two questions, actually, so he's doubling down. Usually we don't allow that, but he's a regular listener, so we'll make an exception for him. He says, one of your listeners did raise a question around the COT report, a.k.a. the Commitment of Traders reports. His question was specifically in the COT report, the commercials and the speculators are always in opposite directions in OI. So his question was, who is right? My understanding is commercials are mainly in a certain direction because they are hedging their cash positions. Could you please clarify, if possible, this? Yeah, that's usually the case. A lot of these reports, they delineate, who the producers or distributors are in these types of products. And you're right, they're usually commercial end users. They have a use case to actually hedge the underlying product. So you're right. These commercials are typically in the hedging category. He also only says, I understand it's lagging and not preferred. However, all-time high is in the open interest, which should surely say something about long-term trends. Would you agree? And he includes a chart here of the net positions for the 30-year out here. And so he says the OI are trending up. So interesting stuff to discuss here. Let's start, Jeff, with you, because Sean and I have weighed in on this topic in the past. The COT reports, seemingly an interesting and somewhat contentious topic these days. A lot of people have written in recently with questions about the efficacy of these things. So let's start there. You trade a lot of futures. What are your thoughts in general around the use cases for the COT reports, or perhaps lack thereof if you're not a fan of them? And then B, what do you have to say about his questions about, delineating the users that they're broken down in the COT report in terms of the hedgers and the commercials and how useful all that information is there, Jeff?
Yeah, for us, we don't really pay too much attention to it. We don't use it on a daily basis to influence our decision making. What we use instead really is just the seasonality of when certain markets typically go up and down. And so that's really what we focus on rather than the commitment of traders. If you take a look and let's say gold is at its all-time highs, commercial hedgers are definitely going to be on the other side of that, whereas speculators are definitely going to be participating in that up move. And that doesn't really tell us anything useful, specifically and especially since we're looking and relying upon price action and charts to make our decisions. And so, it's interesting to see this information, but not really useful for us. And then going back to his question, looking at open interest is helpful to kind of see where the major players are at or the major price levels are at. And it gives us an idea of price targets or where we'd like to take action in area of interest, as I call it. And so that's really what we use it for. Nothing else. We're retail traders, we're small speculators, so we're not able to even use this and move markets or put it to use, if you will. And so, like I said, it's interesting to see, especially when markets are moving in this heavy volume, heavy open interest in certain products. But other than that, that's really it for us.
Yeah, I've taken a similarly dismissive view of the COT reports. Some listeners have written in to defend them. If you use these things, that's great. I don't want to diminish their efficacy for you, but it sounds like, Jeff, you're in the same camp to me. They're a little bit lagging, I think, to put it mildly. In fact, before the show, just to see what they had available, I went onto the CFTC website, and the most recent COT reports they have are for October 6th. So you're talking 9 days in the past, and for pretty active contracts, that's an eternity. That's a long time. So, yeah, from that perspective alone, I don't really see a lot of immediate. A lot of you guys are always writing in with very near-term, near-dated questions about trading these products in the weeklies and other things. Something like that, the COT report is going to be ancient history by the time you get your hands on it. In terms of the users out there, yeah, the commercial traders probably going to be the hedgers across most of them. They have non-commercials. Those are probably going to be the larger speculators, and you got some small speculators in the retail lots in there. So that's how they delineate a lot of these. There's even more delineations if you get in different reports. Like I looked at the energy report right before the show. They have different categories for producers / merchant / users. They even have swap dealers in there now. Then they have managed money. And then they have other reportables there. So they have a lot of different categories depending on where you're looking, energies, ags, things like that. But in general, it's a lagging report, so bear that in mind. I think your point about, the OI is growing, yes, that's useful. And certainly that could show you, hey, maybe things are picking up in this product. Maybe I should pay more attention to. I'm not saying that data point by itself is not useful. I think COT report, if anything, should be just one small part of your arsenal out there. There's a lot of other things. For example, these TWIFO reports we give you every week. Those are much more immediate and show you exactly what's been going on very recently from a vol, from a skew, from an open interest, all these kinds of other perspectives. So I'd much rather rely on those than some dated, aggregated, and maybe questionable data coming out of the CFTC. All right, Sean, put on your question answering pants here. We got time for one more. This is right up your alley. This comes from, I like this handle, Captain Bob 2511. Maybe he's from the future. Maybe he's a spaceship captain. I don't know. But Captain Bob wants to know, Sean, what qualifies as a small cap stock versus what's in the Russell 1000 large cap? We talked about this a while ago on the show, Sean, back when you were doing all things recon, and you guys had to move the goalposts a little bit for what qualifies in the two indices. So break it down here for our space captain from the future, Sean. What qualifies as small cap versus Russell 1000 these days, sir?
Well, my captain, it's a great question. The Russell complex, the Russell 3000 complex, it is a cap-weighted index. So the Russell 1 and 2 are cap-weighted indices. There's a methodology. You look at those 3,000 stocks. You do the cap weights. You look at how their market capitalization adds up in terms of market cap itself. And there's a dividing point between the top 1,000 and the bottom 3,000. This past recon, if I recall, there was a tightening of the separation between the two from a $3.6 billion notional value to a $3 billion gap between the large cap and small caps. So there literally is a gap between those top 1,000 stocks and the bottom 2,000. So that's how FTSE Russell splits between large cap and small cap between the Russell 1000 and the Russell 2000. There's a clearly defined methodology. And, I wish that question was asked last week of Catherine Yoshimoto. She could have really gotten into the weeds for our listener captain today. She was the director of product management. So I hope that answers your question. 3,000 stocks, cap-weighted index, top 1,000. There's a gap of about $3 billion between the 1 and the 2 currently, or I should say that was at recon, at the time of recon back at the end of June. But that's the methodology FTSE Russell uses, and Captain, I hope that answers your question.
All right, everybody. That music means, unfortunately, we've come to the end of this epic journey through the world of all things futures options. But before we go, I want to thank our guest there, Mr. Jeff WHITT, the co-founder over there at Simply Derivative. Jeff, if folks are intrigued, they want to hit you up to talk gold, equities, energy, or anything else over there, where should they go? What should they do, sir?
Yeah, absolutely. Thanks for having me on, Mark. I really appreciate it. If anybody's interested and wants to learn a little bit more and understand market movement and price action, you can visit us at simplyderivative.com. You can follow us on Twitter or our YouTube channel. Post tons of free videos and show you exactly what we do each and every day in the markets, and be more than happy to help out anyone.
There you go. Check them out, Simply Derivative. Give them a follow over there on the old Twitter machine at Simply Derivative. They're getting fancy with the spelling, no I, SMPLOY, derivative is the place to go. And Sean, you kind of teased it at the top of the show, but you guys have some big webinars coming up. What do you guys have in store for us? And if folks want to check them out, where should they go? What should they do?
Thanks, Mark. And again, Jeff, really great to have you on the show today. We've got a slew of webinars coming up. October 21st, we're partnering with the Singapore Futures Exchange, SGX Singapore Exchange, on some FTSE Russell Singapore index futures that will be the highlight of that webinar on October 22nd. And I'm going to get you the invitations to all of these, Mark, so that you can push these out to our listening crowd. But on October 22nd, we have a really interesting one regarding driving U.S. equity markets and its recent outperformance. Same topics that we've been talking about on several of our past shows. And this is not just futures, but it's going to be the entire ecosystem of products trading in this ecosystem, in this index arena of our Russell 1000 and 2000 complex. So, index futures, ETFs, they're all complementary products in regards to the Russell franchise of product. So within this webinar, we've got our guest from our last show, Catherine Yoshimoto. She's going to be the moderator. We have Christy Achillian from BlackRock iShares, who's going to talk about the security side of Russell indexes in terms of ETFs. Tim McCourt, our good friend, Global Head of Equity Products at CME Group, talking about the derivatives in regards to trading those products and the efficiencies of trading large notional values there and in terms of trading and hedging and how to do that. And from the FTSE Russell side, we have the Head of Investment Research, Mark Barnes, who's fantastic. And it's going to be a really, really good presentation. And it's for the entire marketplace. It's not an institutional founded webinar. It's for everyone. It's for all of our listeners that can really gain some insight into large cap versus small caps and them separately as various investment vehicles. And then on November 11th, Catherine Yoshimoto is coming back to another webinar hosted by our good friends over at CBO Global. And it's going to be the Russell 2000 as the topic and harvesting volatility in the various options that trade at CBOE Global. Catherine's going to talk about the indexes. Wilshire is going to be talking about volatility, and Neuberger Berman, a fantastic fund manager, will be talking about the ability to trade the options to harvest that volatility. So it's going to be a fantastic webinar. I'm going to get you all of those invites, Mark. And I'm very excited to be talking about those today. And we'll make sure that everybody listening today and in Fold will be able to register for these fantastic webinars coming up.
There you go. Check it out for yourselves. FTSERussell.com/webinar is the place to go to find all that. Of course, we'll have all the links. We'll tweet them out for you guys as well. And of course, if you want to follow all the reports we talk about here on this show and everything else, place to start, cmegroup.com/TWIFO, TWIFO, or /TWIO, TWIO. They both work. They both get you to this week in futures options reports. You can break down all the good stuff that we have going on in the show. Remember, set the date to our show date here, which is, of course, October 15th right now, if you want to see exactly what we were talking about today. Otherwise, have at it. You can do it 2 a.m. They all work, and you can crunch those numbers. If you want something a little bit more immediate, maybe a little bit more effective than the COT report, there you go. TWIFO is the place to go. And on behalf of Sean and everybody over there in FTSE Russell land and everybody over there in CME land and our guest in the hot seat this week, Jeff, and of course myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in such great questions. Keep them coming. And we'll see you back here next week for another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.